Hello, everyone. This is Big Economist speaking, and today we'll be diving into recent developments in the realm of new vehicle transaction prices. However, before we kickstart, remember to save both your time and money during your next car acquisition with My Car Buying Guide, accessible via the link in the description box. Moreover, if you are interested in more content of this nature, do subscribe as I upload daily. Let's dive right in. Kelley Blue Book, a trusted source for automotive information, has recently released a comprehensive report shedding light on the average transaction prices of new cars in both the luxury and non-luxury segments. The findings reveal an interesting trend. New car prices are currently on the rise. This trend becomes apparent when examining a graph that depicts the fluctuations in prices over time. During the pandemic, prices experienced a significant surge, followed by a slight dip, and now they are gradually climbing once again. This indicates the possibility of a new normal in the automotive market, which we will delve into further later on. Specifically, in the month of May, new vehicle transaction prices showed a 3% increase compared to the previous year. Although this increase is not as dramatic as the astonishing 13.5% rise witnessed from May 2021 to May 2022, it is worth noting that most of the price surges occurred in 2022. In comparison, the recent month's increase appears more moderate. However, it is crucial to highlight that despite the 3% increase, the average consumer is still paying below the manufacturer's suggested retail price, MSRP. This is in contrast to the previous year when consumers had to pay prices exceeding the MSRP, indicating a shift in the supply-demand balance in favor of greater supply. When examining the transaction price increases, a clear distinction emerges between the luxury and non-luxury car markets. Non-luxury vehicles have experienced a more substantial rise in prices, influenced by a range of factors. Affordability plays a significant role in this disparity, as non-luxury cars are generally more accessible to a broader range of consumers. Additionally, the luxury car market has seen a softening effect, which contributes to the stronger price increase observed in non-luxury vehicles. Another contributing factor is the increased production of luxury cars, resulting in intensified pricing dynamics and pressure on their prices. When we examine the luxury car market more closely, we observe its continued prominence, holding an impressive 18.4% share of the U.S. automotive market, despite recent signs of softening. Luxury cars, renowned for their prestigious branding and high-end features, have long been the aspiration of consumers seeking an elevated driving experience. Although the luxury car market has experienced some moderation in recent times, it remains a dominant force in the industry, capturing the attention of discerning buyers who value luxury and exclusivity. In contrast, the realm of electric vehicles, EVs, has witnessed a remarkable transformation. The prices of EVs have undergone a substantial decline, with an average drop of $9,000 compared to the previous year. This significant decrease in price has made electric vehicles more accessible and affordable than ever before, contributing to their growing popularity among consumers. The convergence of lower prices, technological advancements, and increased awareness about environmental sustainability has fueled the demand for EVs, driving the industry towards a greener and more sustainable future. While the decrease in EV prices is noteworthy, it is essential to recognize that electric vehicles still represent a relatively small portion, accounting for approximately 7% of the overall automotive market. However, this modest market share should not overshadow the fact that the trend of increasing EV sales is expected to persist and grow stronger. In fact, the year-over-year sales growth for electric vehicles has been a staggering 44%, outpacing the growth rates of many traditional legacy automakers. This remarkable growth reflects a significant shift in consumer preferences towards electric vehicles and signals a transformative change in the automotive landscape. Consumers' growing enthusiasm for greener transportation options is driving the surge in electric vehicle sales. The increasing awareness about environmental issues and the desire to reduce carbon footprints have prompted individuals to consider electric vehicles as a viable alternative to traditional gasoline-powered cars. Additionally, Advancements in EV technology, such as longer battery ranges and improved charging infrastructure, have alleviated range anxiety and addressed some of the concerns associated with electric vehicles. As a result, more consumers are embracing electric vehicles as practical and sustainable choices for their transportation needs. Despite the overall increase in average transaction prices for new vehicles across the automotive industry, automakers have proactively responded to this challenge by offering various incentives to potential buyers. The average incentive spend has now reached approximately $2,000, although it is lower than the pre-pandemic range of $3,000, $5,000. This upward trend in the provision of incentives demonstrates the commitment of automakers to support their customers and alleviate the impact of rising transaction prices on consumers' budgets. These incentives serve as strategic tools employed by automakers to stimulate car purchases, enhance affordability, and maintain sales momentum. By offering discounts, cash rebates, or special financing options, automakers aim to make electric vehicles more accessible and appealing to a wider range of consumers. These incentives not only attract first-time buyers, but also encourage existing EV owners to consider upgrading to newer models. Moreover, the provision of incentives fosters healthy competition among automakers, compelling them to continuously improve their offerings and make electric vehicles more competitive in terms of pricing and features. Looking at the broader implications for the car market, it becomes apparent that the luxury car segment is likely to continue experiencing a softening trend, although there will be exceptions for highly sought-after models. This means that prices for luxury vehicles may decrease or stabilize. On the other hand, the non-luxury sector, particularly the market for affordable vehicles, is expected to remain strong. The high demand for these vehicles will continue to drive up average transaction prices, with consumers willing to pay full price or even a premium above the manufacturer's suggested retail price, MSRP. This shift in market dynamics could indicate a new normal, where the average cost of a new car represents a significant portion of the average American's income, approximately 40 weeks' worth. The reduced inventory levels caused by production challenges during the pandemic contribute to this situation. While a drastic crash in prices across the entire market is unlikely, struggling models may see the implementation of more substantial incentives to boost sales. Automakers and dealerships will likely offer attractive deals and discounts to entice customers to purchase these models. On the other hand, high-demand models are expected to maintain their prices, taking advantage of favorable market dynamics. The laws of supply and demand come into play, with popular models commanding higher prices due to their desirability. It is important to remember that market dynamics can vary significantly depending on the specific products and manufacturers. Different brands and models will experience unique conditions and pricing strategies. It is essential for consumers to stay informed and research their options thoroughly to make well-informed decisions. As we navigate through these evolving market conditions, it is crucial to stay up to date with the latest developments. Stay tuned for more updates and insights on the car market. In the meantime, I look forward to seeing you in the next video.